Hello, I'm Ryan Lightfoot-Brown of Fund Caliber, and today I'm joined by Dan Roberts, the elite rated manager of the Fidelity Global Dividend Fund. Dan, thank you very much for your time today.
Thank you for having me.
2020 was a difficult year for many reasons, and particularly amongst the global dividend situation. Moving on to sort of today, that picture's changed a little bit. Can income investors be a bit more optimistic about markets this year?
Yeah, I think so. As you say, 2020 was a very difficult year for dividend investors. Dividends fell by about 10% globally, but the cuts were really concentrated in certain geographies and sectors. So, for example, in Europe, dividends fell by over 20%, whereas in the US, they barely fell at all. And of course, industries which were most impacted by lockdown, so think travel and leisure, real estate, financials, energy, they were where we saw the big declines. Now, just as the drop in payouts wasn't uniform, I wouldn't expect the recovery in 2021 to be uniform. The companies that were or still are most impacted by lockdowns are unlikely, I think, to be in a hurry to start paying dividends in 2021. Many have just raised equity. They need to repair their balance sheets. And frankly, the extent of any kind of permanent damage to business models is still unclear. Will there be as much footfall through office canteens, for example, or how much pent-up demand is there for cruise holidays, etc.? So that's one bucket where I think there's big question marks over how quickly dividends will come back. There's also a cohort of income stocks which, in my opinion at least, had been over-distributing for a while, where the events of 2020 prompted a cut and a chance to reset lower. So I perhaps put some energy companies in that camp, and notwithstanding the difficulty of predicting commodity prices, I would expect it to take several years for dividends there to regain their lost ground. But against that, there are instances of dividend cuts which, with the benefit of hindsight, were clearly overly prudent, whether that was due to conservative management team or perhaps a local regulator. There, we should see dividends bounce back quite quickly. The financial sector is an obvious case in point there. And we must keep in mind that the majority of companies over the course of 2020 maintained or even increased dividend payments, and those dividends are likely to grow again as business improves over the course of the next year. And thankfully, much of the portfolio is in that latter camp. So we only saw cuts or suspensions across less than 10% of the portfolio. And that was more than offset by growth across the remaining 90%. So we actually managed to increase the distribution over the course of 2020.
Well, that's a great result for people who are already invested with you. And moving sort of geographically, you seem to be favouring European and UK companies in your fund at the moment. What's the reason behind that?
Yeah, I guess just a note of caution when you do that type of analysis, because when you pick up the fact sheet, you see the portfolio exposure by domicile. So that's where the head office of the companies we invest in are based, essentially, rather than where the company does its business or sells its wares. So a lot of our UK and European companies are actually multinationals. It's not unusual for them to do more than 50% of their business outside Europe. So if you look instead at the kind of economic exposure, as we call it, or the revenue exposure of the portfolio, you'll see it's roughly 1/3 Europe, 1/3 the Americas, and then 1/3 Asia and emerging markets. So I would say there's quite a nice geographic balance to the portfolio. Having said that, there's a few dynamics worth pointing out. There's definitely, as I'm sure you're aware, a stronger dividend culture in Europe and the UK than there is in, for example, the US. If you think about the return of capital to shareholders in Europe, that tends to be 80-20 in favour of dividends over buybacks, whereas in the US, it's 40-60. So that's clearly helpful for a dividend investor. And bear in mind that about 30% of US companies don't pay any dividends at all, and over half the market yields less than 1%. So although the US is a big market, there are large parts of that market which are effectively inaccessible to a dividend investor. And then finally, in terms of valuations, if you look at index level metrics, then yes, the UK and Europe does look more attractive than particularly the US. Though again, we need to be careful here, as much of that discrepancy can be explained by the different kind of market structures. And what I mean there is that if you take the US, for example, they have much more exposure to growth via tech, by healthcare and consumer companies. If you come across to Europe, you have much more banks, energy, mining, telcos. These are lower growth, lower return, commodity-like businesses, if you will, which tend to trade on lower multiples as a result. So yes, we do think valuations favour Europe over the US, but perhaps not to the extent that those headline metrics would suggest.
Oh, that's interesting. Thank you. Perhaps sort of moving on from that, I mean, you are a dividend fund, so the majority of the companies in your portfolio need to be established payers before you'd invest in them. But are there any exceptions to that? Are you finding sort of opportunities in places like Japan where the dividend culture is now improving?
Yeah, we're unlikely to buy a company which doesn't pay and has no stated intention of paying a dividend in the near future. But we do give ourselves the opportunity to own below market yielders, if you will. And it's worth saying that in this regard, we tend to look at the dividend potential of the business, as I would call it, what we would call a free cash flow yield. And we have some flexibility around whether that capital generation, that free cash flow generation, is returned as a buyback or as a dividend. Now, you mentioned Japan, and I would agree. The region looks interesting. Your valuations there look attractive. Balance sheets are very strong. Over half of Japanese corporates have net cash on their balance sheet. And there seems to be a steady improvement in governance and capital allocation from the region. So we do have some ownership there, more than a lot of dividend funds do, but we're still held back by the lower payout ratio of the region. So the payout ratio, the percentage of profits that tend to get returned in the form of dividends for Japan, is about 35%. And as a result, the market yield is a little lower, at about 2%.
Thank you. Now we've talked a lot about sort of different countries, and you obviously, being a global dividend fund, you can invest anywhere in the world. So there's a huge amount of opportunity for you to pick from. How do you go about just selecting only a few for your portfolio? What exactly are you looking for?
Yeah, it's a good question. On the face of it, it's a daunting task. There's 3,000, I should say, stocks in the kind of the universe that we can select from. So to whittle that down to 40 or so stocks in the portfolio is quite daunting. But I think the key is to be very clear as to what you're looking for in a potential investment. For us, we talk about two things. We talk about valuation and visibility. So we have a valuation discipline. We do not want to overpay, no matter how attractive we think a company's fundamentals may appear. And then in terms of visibility, here, what we mean is we're looking to gain confidence in the persistence and the duration of returns that the business is generating. And that will draw us more towards companies with, for example, a high percentage of aftermarket revenues or non-discretionary purchases, maybe subscription-based business models. So those are the kind of companies we gravitate towards. Now, the point is, knowing what we are looking for, we can then design metrics which will help us to identify companies with those kinds of characteristics, and then filter that universe of 3,000 or so companies to quickly down to a much more manageable number from which to construct a portfolio of 45 or so stocks. And I think an unconstrained mindset is also important here. We don't want to waste any time worrying about what we don't own, but instead make sure we're on top of and happy with what we do own in the portfolio and the role it plays.
Well, Dan, as ever, that's been really interesting. Thank you very much for your time today.
Thank you, Ryan.
And for more from the elite-rated Fidelity Global Dividend Fund, please visit our website, fundcaliber.com. And for more from our video series, please don't forget to like and subscribe below.